Current market data indicates that Plug Power Inc., ticker symbol PLUG, is currently sitting at exactly 2.32 USD, having moved down by 0.040 points or 1.69% for the day. Since the market is currently closed as of Saturday, December 13, 2025, this figure reflects the final closing price from the last active trading session. You might look at that price, just over $2, and assume this is simply another beaten-down small cap waiting for a bounce, or perhaps a bargain bin opportunity for those using Schwab Intelligent Portfolios to diversify into high-risk energy plays. But the reality lurking behind that red percentage sign is significantly more complex and, frankly, far more dangerous than the average retail investor realizes. The expectation right now is that the hydrogen economy is merely hitting a speed bump, a temporary pause before the green energy infrastructure bill fully kicks in and sends stocks like this back to the moon. Investors on Robinhood and similar apps have been holding on to this belief for years, viewing the $1.66 billion Department of Energy loan guarantee announced back in January 2025 as the ultimate safety net. However, the reality is starkly different. We are not just looking at a speed bump, we are staring at a potential liquidity crisis that has forced the company to suspend activities related to that very same DOE loan, a lifeline that was supposed to be guaranteed. This is the classic tension between the hopeful narrative of the future and the brutal arithmetic of the present. While the expectation is that government backing ensures survival, the reality is that political shifts and capital allocation strategies have forced Plug Power to pause its engagement with the loan program to avoid defaulting on its terms or losing access permanently. This creates a curiosity loop that demands we look closer. If the government loan isn't the instant fix everyone thought it was, what exactly is keeping the lights on at Plug Power? To understand why this stock is trading at $2.32 and not $20, we have to strip away the optimism and look at the cold, hard mechanics of the market over the last few months. The recent price action has been brutal, characterized by lower highs and lower lows, a technical structure that usually screams avoid to anyone using interactive brokers or advanced charting software. The drop of 1.69% in the last session wasn't just general market noise, it was a continuation of the selling pressure following the company's decision in November to raise $375 million through convertible senior notes. When a company dilutes its shareholders at these levels, it sends a very specific signal. They need cash, and they need it now. This move triggered a 16% plunge recently, a reaction that caught many SoFi Invest users off guard, as the expectation was that the DOE loan would negate the need for such aggressive dilutive financing. But let's pause for a second. If you are sitting there with Apple stock or Tesla stock in your portfolio, you are used to volatility, but you are also used to businesses that generate massive free cash flow. Plug Power is the antithesis of that. It is a capital-intensive beast. The trading volume we saw in the last session, over 114 million shares, was significantly higher than the average, indicating that institutions are actively repositioning. This isn't just retail traders on the Robinhood app flipping shares for a quick buck. This is heavy volume distribution. When you see volume spike on down days, it suggests that the smart money, the funds managing billions in Fidelity wealth management accounts, might be reducing their exposure or exiting entirely. The common ground here is that everyone agrees that hydrogen is a necessary part of the global energy transition. We all know that batteries, like those powering the cars driving the value of Tesla stock, cannot solve every energy problem, particularly in heavy industry and shipping. That is the bull case that makes people want to invest online in PLG. But we have to challenge this with the contrarian take. Being in the right industry doesn't mean you're the right company. The hydrogen economy might succeed while Plug Power struggles to survive its own balance sheet. The company reported third quarter 2025 revenue of $177 million, which actually missed analyst estimates. More alarmingly, their net margin was a negative 313%. Let that sink in. For every dollar of revenue they brought in, they spent $3. This level of cash burn is unsustainable without constant capital injections, which explains the convertible notes and the endless dilution that has crushed long-term holders. If you are managing your own funds, perhaps through self-investing on a platform like E-Trade or utilizing Fidelity ETFs to gain broad exposure, you might look at Plug Power and wonder if the bottom is in. The stock is hovering near its 52-week lows, but technical support is a tricky thing when the fundamental floor is falling out. The suspension of the DOE loan is the critical pivot point here. The company stated this was a strategic move to reallocate capital, but to a cynical market observer, it looks like they couldn't meet the conditions required to draw down the funds, or they feared the incoming administration might scrutinize the deal. This uncertainty is poison for a stock price. It turns an asset that was supposed to be government-backed into a speculative gamble. Let's dig deeper into the actual business operations, because this is where the story gets even more nuanced. Plug Power isn't just a concept stock. They have real assets. They opened the Georgia liquid hydrogen plant, which produced a record 300 metric tons in April. This is a legitimate engineering achievement. They are the largest producer of liquid hydrogen in the U.S. right now. They have deals with Amazon, Walmart, and Home Depot to power forklifts. If you walked into a Fidelity brokerage office and asked an advisor, they would tell you that these partnerships are the company's moat. But the reality exceeds this expectation in a negative way. Those contracts, while generating revenue, have historically been margin dilutive. It cost Plug Power more to deliver the hydrogen than they were paid for it. They have been trying to renegotiate these deals to raise prices, but that is a slow process. The growth in their electrolyzer business, up 46% sequentially in the third quarter, is a bright spot, showing that the technology works and is in demand. But can they scale it profitably before they run out of runway? The macroeconomic backdrop of late 2025 adds another layer of pressure. We're looking at an environment where interest rates, while stabilizing, remain higher than the zero-interest environment that birthed the clean energy bubble of 2020 to 2021. For a company with high debt and negative cash flow, the cost of capital is everything. When they issued those convertible notes, they had to offer attractive terms to entice buyers, which further hurts existing shareholders. If you are using Schwab Intelligent Portfolios, your algorithm is likely underweighting stocks with this kind of debt profile. The comparison to Nvidia stock is unfair but instructive. Nvidia grew into its valuation by delivering earnings that shocked the world. Plug Power has been growing its top line while its bottom line continues to bleed. This brings us to the institutional landscape. We have seen significant shifts in who owns this stock. BlackRock and Vanguard are still present, largely because Plug is included in so many clean energy indexes that Fidelity mutual funds and SoFi ETFs track. They are forced buyers in that sense. However, active managers, the hedge funds that don't have to hold it, have been selling. We saw funds like Tudor Investment Corp reducing their positions significantly throughout 2025. This divergence between passive money, which holds because it has to, and active money, which is fleeing, creates a fragile support level. If the stock drops below $2 and stays there, it risks being removed from certain indexes, which would trigger a massive wave of forced selling from those same passive funds. I want you to pause for a moment and think about your own position or potential position here. It's easy to get caught up in the story of a stock. Comment below how many shares of Plug Power you currently hold, or if you sold out recently, let us know what price you got out at. Seeing where other real investors are positioned can give us a better sense of the sentiment than any analyst rating. Now, let's look at the expectation versus reality of the competitive landscape. The expectation is that Plug is the undisputed leader in hydrogen. The reality is that industrial giants are entering the space. Companies with massive balance sheets, think established oil majors and industrial conglomerates, are building their own hydrogen hubs. They don't need to raise cash at punitive rates. They can fund projects from their own free cash flow. This makes Plug's first mover advantage precarious. If they stumble, these larger players can step in and pick up the pieces, literally buying the assets like the Georgia plant for pennies on the dollar in a distress scenario. This is the risk that isn't priced in at $2.32. We also need to discuss the Project Quantum Leap initiative the company launched. This was their internal program to cut costs and improve margins. We have seen some fruits of this labor. Gross margins have improved slightly from the catastrophic levels of 2024, but they are still negative. The expectation was that by late 2025, we would see a clear path to break even. The reality is that the goalposts keep moving. The company now talks about EBITDA's positive targets in the second half